Nobody looks at a $100 bill and thinks, well, this is going to change my life. That's exactly why it works. In this video, John starts with $100 a month in one of the most popular index funds in the world. I'm going to break down exactly what happens after 1 year, 5 years, and 10 years. Then I'm going to extend the timeline, introduce a second fund, and in the end, I'll show you how the same $100 a month could be paying John over $1,500 a month in dividend income. It all starts with what John has right now. John has $100 a month. That's a phone bill, a few takeout orders, a pair of shoes he'll forget in about 6 months. He's not sitting on a pile of savings. He doesn't have a finance degree. He just knows he should be doing something with his money besides spending it, and $100 a month is what he can start with. The question isn't whether $100 is enough. The question is what happens when he stops spending it and starts putting it somewhere that grows. That somewhere is the part that trips people up, because the answer is simpler than they think. When John hears investing, he pictures picking stocks, finding the next Tesla, and watching charts all day. That's not what this is. An ETF, an exchange-traded fund, is one purchase that buys you a piece of hundreds of companies all at once. Instead of guessing which company's going to win, John buys a basket that holds all of them. If one company has a bad year, the others carry the weight. He doesn't need to research earnings reports. He doesn't need to watch the market every morning. He buys one fund once a month, and the basket does the rest. This is what makes an ETF the starting point for someone like John. Not because it's exciting, but because it's simple enough to actually stick with. Before John picks his fund, there's one thing you need to see first, because this is the main reason why $100 a month works. It's called compounding. Let me explain with an example. Say you invest $100 one time into a stock trading at $5 a share. That gets you 20 shares. Now say that stock pays a $5 dividend yield, which means it pays you $5 a year just for holding it. Not much. But you don't spend that $5. You use it instead to buy one more share of the same stock. After year 1, you own 21 shares worth $105. The dividend is no longer on 100, it's on 105. So year 2, it pays you $5.25. That buys you another share and a fraction. Now you have 22 shares worth about $110. Year 3, the dividend is 5.51. You reinvest again, 23 shares, $115.76. You never added a single dollar. The money made its own money, and then that money started making even more. And here's the part that matters. This example assumes the share price stayed flat at $5 the entire time. It didn't grow at all. If the share price grows on top of the dividends, that's a second layer of compounding working at the same time. What you just saw was only one layer. Now scale that up. John's not investing $100 one time. He's adding $100 every single month. Every $100 he puts in joins a machine that's already running. The first 100 has been compounding for months by the time the fifth 100 shows up. And by the time the 50th shows up, the first one has been growing for over 4 years. That's why the starting amount doesn't matter as much as people think. What matters is that John keeps showing up. So where does John put that $100 a month? The most common answer in the world is an S&P 500 index fund, and there's a reason for that. The Vanguard S&P 500 ETF, ticker VOO. It tracks the 500 largest companies in America: Apple, Microsoft, Amazon, Johnson & Johnson, all of them in one fund. John doesn't need to pick which one is going to win. He owns a piece of all of them. Now, VOO charges an expense ratio of 0.03%. That means for every $10,000 John invests, he pays $3 a year in fees. That's as close to free as it gets. The fund blends out to a 1.14% dividend yield, a 6.07% dividend growth rate, and an average annual share price appreciation of 12.7%. And that appreciation rate is what's going to do most of the work over the next 10 years. So what happens when John puts his $100 a month into this fund and doesn't touch it for a decade? That's what I'm going to show you next. And later in this video, I'm going to introduce a second fund that turns the same $100 a month into over $1,575 a month in dividend income. But first, here's what the projections show. After 1 year, John would have put in $1,200. This sets the stage for future growth. After 5 years, he would have contributed $6,000. His account is projected at $7,875, almost $2,000 that he never deposited. That's the compounding that we talked about in the $5 example, except now it's running on 5 years of monthly contributions. After 10 years, John would have put in $12,000. His account would grow to $22,606. The fund would have added over $10,000 on its own. He doubles his money without doubling his effort. That is what 10 years of consistency looks like inside an S&P 500 index fund. But what if John continues? Well, here's what happens when John keeps going after 10. The title of this video is 10 years. John got his answer, but the $100 a month is already automatic. It costs him nothing extra to just leave it running. After 20 years, John would have contributed $24,000. His account is projected at $99,816, just $200 away from six figures on $100 a month. After 30 years, the contributions would total $36,000. His account would grow to $358,324. The fund would have added $322,000 that John never earned at a job. And that's not a different strategy. That's the same $100 a month with 20 more years of compounding behind it. But John checks something else. He looks at how much VOO is paying him in dividends. After 30 years, on $358,000, the fund is projected to pay him $41 a month. $41 on $358,000. The account grew, but the income did not. And that's not a flaw in VOO. Income just isn't what VOO was built to do. But there is a fund that's built for income. This is the Schwab U.S. Dividend Equity ETF, ticker SCHD. It doesn't try to compete with VOO on growth. It holds around 100 companies selected for one thing: paying dividends consistently and growing those dividends over time. The fund blends out to a 3.41% dividend yield, a 10.43% dividend growth rate, and an average annual share price appreciation of 8.59%. The appreciation is lower than VOO, about 4 percentage points lower, but the dividend yield is 3 times higher, and the dividend growth rate is nearly double. That's the trade. SCHD grows your account using dividend compounding, and it pays you while it does it. John runs the same setup, $100 a month, same schedule, same discipline. After 10 years, SCHD is projected at $21,472. That's about $1,100 less than VOO at the same point. If John stopped there, VOO wins, no question. After 20 years, SCHD is projected at $95,414. VOO is still ahead, but the gap is shrinking. After 30 years, SCHD would grow to $374,764. VOO is at $358,000. SCHD passed it. And the dividends, $18,898 a year. That's $1,575 a month from the same $100 a month that John would have been investing the entire time. VOO built the bigger account for 2 decades and ended up behind. SCHD spent 20 years losing the race and then won it while paying John more per month than some people earn in a week. Neither fund is wrong. VOO is for the investor who wants growth and plans to sell shares later. SCHD is for the investor who wants the account to pay them without selling anything. Same $100, same 30 years. 2 completely different outcomes. If you want to see what happens when two of the biggest fund providers go head-to-head, $100,000 across 5 rounds, Fidelity versus Schwab, that video is on screen now.